And welcome back to the Financially Simple Experience. Today I want to answer a listener question. I've never addressed this question to the degree or to the depth that I want to tackle it today. I think it's one, though, that has merit. You know, most of us business owners are not experts in the world of finance, in the world of valuation, in the world of growth, in the world of marketing. We know just enough. We know just enough to figure out what the market needs through this capitalistic market, that we can provide the supply for the demand that we see. That's what we're good at, is supply demand. So whenever we get into some technicalities, we have to have experts come alongside. But many times the experts' language is confusing. It's confusing. So I want to answer a listener question. The question is, what is the difference between a formal valuation and an informal valuation? This particular listener said, Justin, so we're interested in selling our company. Interesting. What type of sale? Remember the types of value, what type of sale, he doesn't say. And I was provided a benchmark appraisal, which is called an informal valuation, friends. But I thought it was going to be formalized. I thought it was going to be a formal valuation. What am I missing? So I think his initial question is interesting. What is the difference between a formal valuation and an informal valuation? So in order to answer this question, we have to do a little bit of diving into this topic of valuation. Now, look, friends, I'm not trying to make you an expert in the world of valuation. Candidly, I am not an ABA or a CVA. Those are two designations that are often received by those who want to build a career out of valuing businesses. No, I'm a CVGA. I'm a Certified Value Growth Advisor. We can do benchmarks or informal valuations on businesses for planning purposes or for exit planning purposes, but there are many times that you need formal valuations in place. So we first have to, in order to answer the question, the difference between a formal and an informal valuation, we have to start at the beginning. So let's begin with, what is a business valuation? That's the simplest question we can begin with. Well, the answer to that is, and here's your textbook answer, a valuation is a technique that looks to estimate the current worth of an asset or company. That's a technical answer. So what does that mean? Well, it's an estimate. It's a guess, a benchmark. The valuation that we get, whether it's informal or formal, is not the end-all be-all, because we don't actually know the value of the business until perhaps at the time of closing, the sale of the business. When it closes, we know the value at that point, because now we have a transaction that occurs. Or maybe there's a liquidation. Until the liquidation is done, then we know the value of that business. So we really don't know the value until the time of consummation comes about. Let's compare a business to a piece of real estate. Let's say selling a house. Most of us have experienced the joys and the angst and the frustrations of trying to sell a house. A realtor will pull up market comps or comparables to try to determine a list price. And they put a list price out there to try to attract buyers to look at your house and ultimately close or consummate the particular transaction. Ultimately, the sales are negotiated by the buyer and the seller to determine the final price. If you're trying to determine it from a business, it's much more complex. Why? Well, most businesses, at least the ones that we work with, are privately held businesses. Well, what does that matter? Well, they're private. We don't know the full details of businesses. Sure, we can go out and see the details from some similar businesses in the same SIC code, SIC code, or the NAISC code. We can see similar values, but we really don't know the true value of private business sales. So ultimately, value is a rough estimate that we believe, whenever you're doing exit planning or whenever you're doing even formal valuations that you're paying an ABA or a CVA to do, it's a rough estimation that we believe a willing buyer will pay for the business based on the tangible or intangible assets. So if we understand that it's an estimate, now we have to understand the word value. Value. There are several types of value, and for sake of time today, I'm not going to dive into all the various types of value, but most commonly when people say, hey, I want a value done on my business, they're talking about market value. They're not talking about fair market value. I address this in my book, The Ultimate Sale. They're not even talking about fair value. They're talking about market value. And market value is commonly referred to as a market capitalization rate is determined by your business's stock, and we're talking about publicly traded company. So there's certain ways to deal with this. And in a private company, it can be used in a business auction. It's merely the highest value a company would receive on the open market if multiple parties were interested in bidding or bidding for this particular piece of business or this particular equity, this business. So market value. But let's not get confused here, friends. Sometimes a valuation is trying to determine fair market value or fair value or investment value or strategic value or book value or liquidation value or forced liquidation value or collateral value. So I asked this rhetorical question. You're getting a valuation done. You're trying to determine the value of your company. What specific value are you trying to determine? You see, whenever they enter in the world, whenever people engage our services, they typically don't have a buyer in mind at that particular point. They have lots of ideas that they want to accomplish, but they really haven't narrowed it down onto one specific pattern. So because it's unclear at the time whenever many people engage us, I mean, they could sell stock to another shareholder. They could gift it to a child. They could sell it to a mergers and acquisition firm. They could do an ESOP plan and bring in the employees to the company. They could do a partial sellout. They could do a merger with somebody else. We just don't know many times what the owner of the business really has in mind. Which is why, sidebar here, why I often recommend that every business owner, this is our process in our company, that the business owner must go through personal financial planning first, because we need to understand what are we trying to accomplish and why, and what's the long-term ramifications of this action. So if we understand value, okay, now let's answer the question, when are business valuations needed? When are they needed? There's several examples. I'm going to give you many of them here. They're needed for reporting purposes, shareholder and investor reporting. So in a publicly traded company, it's not uncommon for a formal valuation to take place for shareholder reporting. You may need it for lender requirements. Some banks require an estimated value of the company. Typically, this is an informal valuation. Stock option plans are typically required by law per 409A regulations to have a formal valuation on the plan. ESOPs are the same thing. Conversions from C Corps to S corporations are often looking at book value many times, from the conversion from C to S. Gifting of ownership. Man, there's all sorts of valuations that are needed there depending on what type of gift we're dealing with. Are we dealing with a gift to the children, to the charity, to the trust? Maybe it's through an estate. Each of those could bring about different types of valuation needs. Maybe it's bonusing employees' ownership through some sort of a stock option plan. Not an employee stock option plan, but something as a bonus to give them company stock. That requires a different type of value. Then you go into disputes. Many times that involves the IRS or courts, and so that typically is going to bring in formal valuation, and marital divorces are going to bring in typically formal valuations. So every type of circumstance that could be needed for a valuation is going to require either a formal or an informal. So now that shifts us to the point of what is the difference between a formal and an informal valuation? See, many times we need to value our company for some reason, as I just mentioned, and it can be for a litany of others that I didn't mention. And valuations can range from informal valuation to a formal, depending on the purpose of the valuation and its intended use. Now, here's where it gets confusing. Many times the methodologies for formal and informal valuations, the calculations, the estimates are the same. Many times they're the exact same methodology. The difference is often the depth of the analysis, the discounting perhaps applied, the purpose of the use, as we mentioned there before, disclosures, and candidly, the time commitment by the appraiser. See, formal valuations are a lot more in depth, and they take a lot more time and a lot more checks and balances than an informal valuation. So why would we choose one over the other? Candidly, most of the time, and I will not going to give a statistic. I remember this attorney that says 86.76% of the time, statistics are made up right on the bat. Right on the spot. The next time you hear him, 97.13% of the time, statistics are made up right on the spot. So I've kept that in my head because I want to say 99% of the time. Well, that's not true, but many times, informal valuations are all you need. These measures are based on a wide range of criteria, and they could use things like multiple of book value calculation, a multiple of revenue calculation, a multiple of normalized NOI calculation. They could use the discounted cash flow method. Each of those could derive some sort of a value. So each criteria is applied to a particular industry. Let me give you an example. In the dental world, it's not uncommon for a dentist to receive 60, 70, 80, maybe 90% of their trailing 12 collections. Let's say a dentist collected $1 million over the last 12 months, and now they want to sell it. Well, that range could be 60 to 90, maybe 100%, depending on the intangible assets of the company. So that's a industry-specific valuation measurement. Now, can you do a formalized valuation for a dental practice? Absolutely, you can. And many times they are needed for various reasons. But the valuation numbers are just going to support whatever the underlying assumptions of the informal valuation. Many times it ends up being the same thing. I've seen this too many times, friends. I'll give you another example. In the financial services industry, we're talking about your stockbrokers out there. If they own their own business, often they can receive 2 to 3 times recurring revenue for the sale of their business. So those are just industry specifics. When an informal valuation is done, business owners, let me say it this way. Often, informal valuations are done before business owners commit to a specific path, a transaction, or a decision. So let me give you an example. Not too long ago, I had a client who said, Justin, I'm interested in selling my company. We did a informal benchmark estimation of value. It wasn't even a true valuation. We ran it into a discounted cash flow methodology. Didn't do all the different points that we needed to examine what the intangible values are. And we came up with a company that was worth roughly about $1.5 million, rough value. Now, it could float either way. It could be worth $1 million to $2 million. Let's put a range on it. But ultimately, it wasn't going to meet the owner's needs. The owner needed $5 million in order to retire. So by doing an informal valuation, it gives information to make a decision on which path is the best path to take. And oftentimes, informal valuations are what is conducted by brokers, by CPAs, many times by attorneys, by the software companies that you could employ online, by exit planners, because it's easy and it gives you the information for decision making. Now, formal valuations are typically obtained by independent experts, typically that CVA or the ABA, coming in and looking at the formal valuation data point. I'm going to pause here for just a second, Adam. I need to check something. Adam, if it's not too hard, I've said the word ABA several times. It needs to be ABV. I don't know if you can incorporate that into the text here, but it needs to be ABV, not ABA. So I'm going to say ABV, ABV, ABV. Maybe you can copy and paste that and cut it in for tonal purposes to make it work. Sorry to do that. I just had that brain thought in the middle of this. So independent experts can spend a considerable amount of time examining company records, and they're going to use several of the same methodologies that we spoke about earlier. They're going to use the multiple revenue calculation, the multiple normalized NOI, but most of the time, they're going to use the discounted cash flow methodology. They're going to use the cash flow methodology for valuation. We spoke about this on the podcast that cash is king. We spoke about Shannon Pratt and his company and how they originally founded and wrote literally the book on valuations. See, formal valuations are often used in legal proceedings, ESOP plans, gift calculation, and tax efforts. That's oftentimes where formal valuations come into play. Whenever you deal with a formal valuation, I've seen valuation prices come from the CVA and the ABV, those professionals. They could charge between $20,000, $40,000, $60,000, $100,000 depending on the complexity of the company. We're working with a company that has a sizable inventory, and the book value or the balance sheets are not audited financial statements. So that means that an appraiser, and I've seen this happen, may have to have audited financial statements, meaning that we have to have market values of the inventory. And so whenever you're dealing with formal valuations, often it's for a targeted reason. One other thing that often happens with formal valuations, you can ask for a fairness opinion. And that's not going through the entire valuation. That's just giving an independent, objective analysis to a deal. In other words, a willing buyer and seller, in the case of a business, is looking at a price, and now you're hiring an expert to look at the terms of the deal, look at the pricing, look at the considerations, and they may determine if this is a fair deal or not. It's called a fairness opinion. That's a formal type of valuation. And it's based ultimately on the experience and the expertise of the person doing that particular valuation. So let's make some application. The majority of the time, as you approach your exit planning, as you approach your decisions to merge, to hire somebody, to sell stock to your company, many times, majority of times, it's going to be an informal valuation, many times. So to the listener whose question came in, let me say it this way. If you're working with somebody you trust, and they have the knowledge and expertise and experience that you trust for your particular deal, and they want to do an informal valuation versus a formal, and there's nothing in the statutes, whether it be law or IRS code, that says you have to have a formal valuation, then more often than not, I would have to anticipate that it will be informal in nature. It's not going to have the same amount of disclosures. It's not going to have the level of scrutiny. It's not going to have the depth of research that a formal valuation will. And candidly, it's not going to have the price point that a formal valuation often charges. So just because you see someone saying, I'm doing an informal valuation, I'm doing a benchmark assessment, I'm doing some sort of a market guess on what the business is worth, if they can quantify their work, and they can use some sort of a strategic methodology, then a formal valuation may not be needed. Again, talk with your entire advisory team. This is why you have attorneys and CPAs and CFPs and all the other experts involved. Talk with your formal advisory team, but don't let the terms informal and formal, for the majority of the times, don't let it disrupt you. So friends, I hope that little lesson today on the two types of valuation helps you. Maybe you're not there yet, but maybe you know somebody who is considering exiting from their business or trying to rapidly grow their business. Now's the time for you to share that information with us. Friends, I look forward to helping you in the future. I realize life is hard, and man, trying to figure out valuation, it's a tough one. It can be frustrating. It doesn't have to be. We're going to continue to make our lives at least financially simple. Y'all make it a great day.